Good morning. My name is Jamie Hott, and I am the chair of Alberta Automobile Insurance Rate Board, and I welcome you to our 2023 annual review open meeting. We would like to take this opportunity to acknowledge the traditional territories of the Indigenous peoples of Treaty 6 region and the Métis settlements in Métis Nation of Alberta, regions 2, 3, and 4. We respect the histories, languages, and cultures of First Nations, Métis, Inuit, and all First Peoples of Canada, whose presence continues to enrich our community. We also acknowledge the traditional lands of First Nations, Métis, and Inuit of those presenting and participating from various parts of Canada. Prior to the pandemic, we held these meetings in person, and we were able to seamlessly pivot to an online format. As you can see, we have chosen to continue with a virtual format for our annual review meetings. A virtual meeting format enables more stakeholders and interested parties to participate in our annual review without the cost of travel. Today we will hear stakeholder presentations and comments about the review of Alberta industry loss experience for private passenger vehicles in Alberta. The AIRB's mission is to independently regulate automobile insurance rating programs and educate consumers to ensure Albertans have access to a robust automobile insurance marketplace. Therefore, today's discussions are important as they affect nearly 2.9 million drivers and the insurance companies actively writing private passenger automobile insurance in Alberta. Under the Insurance Act and the Automobile Insurance Premiums Regulation, the AIRB must conduct an annual review of automobile insurance trends and premiums relating to basic coverage and additional coverage for private passenger vehicles. As part of this process, the AIRB holds this open meeting to hear from stakeholders. We advertise this meeting on our website and notified stakeholders on June 23rd, 2023. The purpose of today's meeting is to receive input to assist the AIRB in analyzing industry experience to develop industry benchmarks for insurers and the AIRB in use of developing and review of rate filings after October 1st, 2023. According to the legislation, the AIRB must consider industry-wide loss costs, administrative expenses, profitability, and any other matters the AIRB considers appropriate. This meeting is an important part of the process the AIRB uses to arrive at its industry benchmarks for rate filings, which the AIRB will post on our website before October 1st, 2023. There continues to be a lot of interest in the Alberta automobile insurance market and results for drivers, the media, and the insurance industry. There are many topics one may want to cover. To be clear, today's open meeting will not address commercial coverage, complaints against insurance companies or the insurance industry. In addition, we would like to acknowledge while the rate pause is in effect, the AIRB has not identified any other matters to hear on for today's meeting and expects presenters to focus their comments on our benchmarks and loss trends. I would also like to remind everyone, presenters and presentations who stray into the matters beyond the mandate of the AIRB's review will be ruled out of order by the chair and will be asked to refocus their presentation. Only those parties registered to present will have the opportunity to make a presentation today. Only members and representatives of the AIRB may ask questions of the presenter during the open meeting. Observers or other presenters will not be allowed to question presenters. I also want to acknowledge receipt of written submissions from the Cooperators Group Limited, Definity Insurance Company, and Desjardins General Insurance Company. The AIRB appreciates your contributions to our annual review and will consider comments made in your submissions. Before we hear from our first presenter, I would like to now introduce each of our board members. Patricia Matthews, who's our vice chair, Matthew Wesolowski, who is our consumer representative, Jay Jurowski, who's a public member, Rita Lazar-Tipe, who's a public member, Christopher Bruce, who's a public member, Vince Favrick, who's a public member, Kathy Matten, who's a public member, and Mark Brisson, Superintendent of Insurance. Also joining the board members, we have Ms. Paula Elliott and Mr. Chris Schneider of Aller Wyman, our consulting actuary, as well as Lori Balfour, our executive director, and the AIRB staff. Just a few housekeeping comments. Before we begin today's presentations. I would like to highlight a few of them. This meeting is being recorded to allow the AIRB to review comments made by each presenter. The AIRB will post recording of today's meeting on its YouTube channel before August 31st, 2023, and a link will be shared on our website. AIRB staff emailed a copy of today's agenda with the video conference details, so each of you should have a copy. Following this meeting, copies of the presentation and written submissions will be available on our website at airb.alberta.ca. We have scheduled this meeting for approximately 3 hours. We will take a 10-minute break following the Insurance Bureau of Canada presentation at approximately 9:35 Mountain Daylight Time, which is Alberta time. We request all presenters mute their microphones when not speaking to minimize disruption and ensure all board members, presenters, and observers can clearly hear today's presentation. Now we will move to agenda item 2 and hear from our first presenter. I invite Mr. Schneider and Ms. Elliott of Oliver Wyman, AIRB's consulting actuary, to present their report, which is a review of the insurance or industry experience. The report was posted to the AIRB website on June 23rd for review and comment by stakeholders in today's meeting.
Thank you. Good morning. I'm Paula Elliott with Oliver Wyman, joined by my colleague, Chris Schneider. We want to thank the board for the opportunity to be here today to present our 2023 annual industry review. And this is based on the insurance industry data that is through to December 31st, 2022. I'll move on to slide 2. Our agenda for today is we will go through our report highlights, which in our report is very similar to our prior reports that we've been providing for the board for many years. And today, on the premise that most of you have read this report or prior reports, we're going to focus on the issues of the loss trends and how they've been impacted by inflation, the policy reforms, and COVID. And then finally, we'll touch on the industry profitability. I'm going to jump over to the fourth slide on the industry benchmarks. So the industry benchmarks in this annual review is intended to deepen the understanding of how claim costs are changing and the influences on those costs. These benchmarks can be applied to rate filings that are submitted through the fall here, October 2023 through to the end of March 2024. And these are, again, as I said earlier, they're based on some analysis of the industry private passenger loss and expense experience through to December 31st, 2022. And some insurers who are using their own data to estimate loss trend rates, they may find that their experience is different, as these benchmarks that we present are based only on the industry data. I'll move on to the next slide. Slide 5. This is a summary of the industry benchmarks that we've presented in our report, and it's a comparison to our prior review. We continue to present what we believe is decline in the post-reform BI trend rate, both our prior review and this review, and there are some relatively small changes amongst the various coverages from our prior review to this review. And I just want to state that the comprehensive trend rate is not updated as we're waiting for the new catastrophe experience that was just released, I believe, yesterday from GISA. I'll move on to slide 6. This is the stakeholder comments that we received on the industry benchmarks. So, and these are generalizations, but in generally comments that were the selections that we have presented as loss trend rates align with those that insurers are seeing. They generally agree with the selections. Some minor differences by coverage, but in aggregate, they're close. And there's a suggestion that the flattening on the BI into the future may not occur, but that's yet to be seen. And one of the things that we did consider in this review is the rise in inflation that occurred, started to spike in 2021. And we use what is referred to as a scalar adjustment or a parameter in the model to reflect that rise, that lift. We had comments that generally are in agreement with the use of a scalar to reflect that inflation rise, and an agreement that the future trend rates, so the data post 2022 that has to be projected forward for a rating program, that the CPI should be considered the latest information on CPI. The other thing that we are seeing in this review is that for bodily injury and AB, we are now seeing that they are being impacted by CPI, and it appears that it's more of a lag than the physical damage coverages, which was very evident in our more recent reviews that they were impacted by inflation. So now I'm going to turn it over to my colleague, Chris, to walk through some of the more pictorial, the graphs that we have by coverage, so you can get a better idea of how the claim costs, severity, and frequency have been changing.
Great. Thanks, Paula. Thanks for that introduction. If we could go to the next slide, please. So over the next set of slides here, I'm going to be giving a high-level review of the historical frequency, severity, and loss cost experience for each major coverage. Frequency, of course, being the number of claims per vehicles, severity, the average claim cost, and then loss cost is the frequency times the severity. So left side, we present a long-term view of over the last 20 years. And the right side, it's kind of honed in on a shorter-term view to see what's going on lately. So starting with bodily injury loss cost, on the bottom left-hand panel, we see an increasing pattern since 2010 up to 2020, where there is this large dip followed by some flattening. And then if we kind of look up above, we can look at what's causing this pattern in loss cost, and we see that the rising loss cost is driven by severity increasing, so claims are getting more expensive over time. And the decrease at 2020 is primarily frequency driven, and as we all know, that's related to the impact of the pandemic and how that impacted driving behaviors during shutdowns and so on and so forth. And interestingly, we see frequency levels have not really yet recovered to pre-pandemic levels as of year-end 2022. And that's going to be kind of a recurring theme here throughout the presentation. If we go on to the next slide. So property damage, this slide is actually very interesting. It's a little different than bodily injury. Historically, loss cost experienced modest positive trend through 2019-ish. Maybe it was some flattening in there until the very large decrease in 2022 and 2021-1. But then there was this, upward spike that we didn't see in bodily injury. And when we kind of break this down by frequency severity components, we see severity has diverged in the most recent few periods. This is since 2021, the second half of 2021. There's an increasing increasing rate of change. So that we believe is related to the inflation spike that occurred during that same similar time. Also, unlike bodily injury, we see the most recent frequency data point has increased to above pre-pandemic levels after you kind of adjust for the historical trend. We think that the introduction of DCPD may have resulted in some shifting of claims between collision and DCPD, and that could explain part of this increase. although this shouldn't happen really in theory, we have noticed a similar phenomena in other provinces where DCPT was introduced. If we move on to accident benefits, this slide is very similar to that of bodily injury. Loss costs have historically increased, and that's driven by an increasing severity trend. We do see some early signs of flattening in the severity trend rate. Over the more recent periods, on the right-hand side, we can see those some flattening since 2020 has occurred. Recognizing that this is, these are just estimates and subject to change, but we do consider that to be informative of where things may go in the future. Moving on to collision. Collision loss costs and severity experienced a small positive trend before the large dip in 2020. I mean, there's some volatility if you're looking at the kind of the bottom left-hand corner here, but when we look at severity specifically, we see a fairly consistent positive trend between 2010 to 2016. And then there's some signs of flattening there, followed by, return to a much steeper trend again. And we think that return to a steeper trend is primarily driven by inflation, because things really did seem to level out quite a bit there for a while, and then we have this large jump again. And the frequency is kind of the same for as bodily injury. We have this flatter pattern, and then all of a sudden large dip during COVID and subsequent. If we move on to comprehensive, we didn't spend a lot of time reviewing comp. As Paul had stated, the GIZA's catastrophe report wasn't available for a preliminary review. I think it got published either yesterday or today. So we will update our comp models for our final review. Of course, hail is a major component of the comp loss cost, and that causes a lot of the volatility that we see in the frequency and loss cost data on this slide. Just to point a few things out, we don't see a large drop in frequency level during the pandemic like other moving coverages, and we also don't see a large inflationary impact, which is a bit odd here. But we do see a little bit of a rise if we look in the middle right graph. That's the short-term view of comp. There does seem to be a bit of a rise in the most recent 3 data points, but it's not as significant as other coverages. And then if we move on to comprehensive theft, we see, as you're aware, I'm sure, the frequency of thefts has been on the rise again throughout Canada, and that's putting upward pressure on comprehensive claim cost, and it could also be explaining some of that recent increases in total comprehensive as well. If we have more thefts and total losses, that's going to put upward pressure on the severity for comprehensive in total. So we did receive a few comments on thefts, and it was mostly just to make sure the AIRB is aware of the impact of thefts, and that the frequency increase is not quite as drastic as some other provinces, such as Ontario, but we should continue to monitor the issue and be aware of it. If we could skip to 2 slides, yeah, one more, and then one more actually. Sorry. So I'm just going to comment a little bit on the inflationary impact in total and kind of what we're seeing. So one thing I've kind of touched on already is the recent spike in inflation, how we are seeing that impact the severity data. The right-hand slide here, or the right-hand side of the slide here, kind of just shows the recent severity data for all coverages, and we see a large increase in the property damage collision severity beginning in the second half of 2021. It's not as obvious for the other coverages like bodily injury accident benefits. Severity is consistent with the kind of historical patterns after you adjust for the recent reform that took place. Under our database approach, we find that property damage and collision change is significant, and quantify that via a additional scalar parameter in the model. To better understand what is causing that change, if we go to the next slide, I'm going to kind of look at the CPI metrics that puts pressure on the claim costs here. So this slide looks at the CPI metrics for two different baskets of goods and the implied inflation rate over the last 20 years. The CPI data is on the left side, and the yearly rate of change, or the inflation rate, is on the right side. So each slide has kind of two consumer price indices. Here we have the all items CPI, and then the transportation CPI. We see both the all items and transportation CPI began to increase very rapidly in 2021 and eventually reached the highest inflationary levels in the last 10 years. We also see the inflation rate has begun to moderate in 2023. And this moderation is why we think that maybe the worst could be behind us. And it's actually the reason we think that a scalar parameter is the best approach to isolating and quantifying impact on inflation on historical claim cost here, specifically for the property damage coverages. We think this is likely a temporary thing, and we can quantify that impact and let it flow, let our model kind of do the legwork here. The next slide, if we go to the next slide, this is the figure kind of drills in a little bit into the transportation CPI and gives them a little bit more insight into what is driving the collision property damage severity increases. The top portion of the figure looks at the cost of purchasing or leasing a new vehicle, and the bottom portion presents the cost of renting a vehicle. Both of which we see, they're increasing at a faster rate in 2021, which is also what we saw in the all item CPI, but the inflationary levels is actually much more drastic here, especially for the rental costs. The rental costs essentially doubled relative to pre-pandemic levels. And if we go to the next slide, the top portion is the cost of repairing and maintaining vehicles. Similar story here. We think that this is the bulk of what makes up the physical damage claims. And we think that this is a good sign that the inflation rate is beginning to moderate in 2023. Last one I'm going to go over is just the healthcare CPI metric, which we tend to relate to bodily injury and accident benefit severity. And interestingly, before the 2023 period, we saw that the inflation rate wasn't really impacted too much by the recent inflationary environment. But as of the most recent few months, the inflation rate is beginning to kind of uptick a little bit, and it's lagging behind the other metrics. It's still not overly concerning as of yet. The level of the inflation increase isn't as concerning as what we saw in some of the other coverages, but that's not to me. That does not imply that that's going to continue into the future as new negotiations are and contracts are put in place to reflect the inflationary environment. And then with that, I guess I will turn it back to Paula to talk about how we think insurers should consider this in their future loss cost or trend considerations.
Thank you, Chris. So just as a reminder, refresher for everybody, all our analysis is done using the data through to the end of December 2022, and we're deriving what would be referred to as past loss trend rates. And in our report, this current report, unlike prior years, we've only presented what we refer to as the past loss trend rates. And typically we would present future trend rates as well. And our future trend rates would typically be the same as our past loss trend rates, unless there was some new emerging pattern that we were seeing, possibly reform or some other reason that we might, in our judgment, select a future trend rate that would be different than the past. But in the environment that we're in with inflation, it is very challenging. We don't know whether inflation may stabilize. Will it fall? Will it rise? We do see some evidence that it's tapering off in the first half of 2023, but there is still so much uncertainty out there with that. And it's certainly, possible we're seeing changes in the availability of vehicles for rental of cars. There are astronomical rates for car rentals that people need a new car, a replacement car when there's an accident, and those costs are coming down. So the point being, there's a lot of uncertainty. And so with the inflation uncertainty in this review, we've chosen to highly recommend that at the time of a rate application, that the insurer look at the most current CPI data, their own data, to see how is their severity being affected by inflation. So that is a recommendation here. In terms of the frequency, one of the interesting things that we are seeing with the second half of 2022, where despite the World Health Organization declaring that COVID as a pandemic had come to an end in the spring of 2023, we're really seeing that life had gone back to, we're calling the new normal, in the second half of 2022. But that new normal, what we're seeing is still a lower frequency level than the pre-pandemic era, despite mobility data indicating that people are, again, moving about at the same level as they were pre-pandemic. So that's another uncertainty we have with the future trend rate. How will frequency really unfold as we enter into the new normal? And we're going to show some graphs on that a little bit later. I'll go to the next slide, please. And some of the considerations that we had from stakeholders is, an agreement that future trend rates may be different than the past trend rates, and that it is important to consider the most recent CPI data. And I also want to make it clear, there was a comment that we don't recommend an inflation adjustment for the future trend rates. And that's true on the surface, but I don't want that to be interpreted that we don't think that there should be an inflation adjustment in the future trend rates. We just don't want to try to forecast what the CPI will be in 2024, and instead want the insurers to consider that when they select their trend rates in their rate applications coming into next year. And the next topic we want to touch on here is the policy reforms. So the policy reforms, we've had, when we consider the reforms, which bodily injury, there was a change in the minor injury definition, accident benefits, the benefits were expanded, and both of those caused changes in cost, with bodily injury a reduction in the severity, and in accident benefits a rise in the severity. So we continue to assume that the initial preliminary estimates that we estimated for these reforms hold. And we have actually also, I'm going to show you and I'll talk about that in a minute, done some preliminary testing, modeling to estimate those costs with the data that has emerged since the November 2020 reforms. And we believe that they are continuing to be reasonable estimates of what those cost impacts will be. In addition, the Bill 41, the reforms, we also think it's possible that it might influence the propensity of a policyholder to pursue a claim, and that can affect the bodily injury frequency. But with frequency being impacted by both COVID, this potential reform, and the short time period, it's hard to separate that too within the frequency data. And then, of course, the other reform, as Chris mentioned earlier, was the introduction of DCPD in January of 2022. So we only have one full year of data on that, but there does appear to be evidence that there is a shift of claims from collision to DCPD. I think that in terms of comments from stakeholders, there's still a question mark whether the 18% reduction on severity, BI severity, will hold. And we certainly need more time to pass till we can confirm that. And monitoring, understanding why there is this shift in DCPD. I'm going to go to the next slide, and this is a graphic presentation of the severity models for bodily injury and accident benefits. And in these models that we've presented, we're trying to isolate the cost impact of the reform. And we do that through a parameter that we use for the November 2020 reform. And our model is showing for bodily injury approximately an 18.5% reduction on severity. And in that case, what we refer to as a p-value to show that that estimate is statistically significant is very good. The results have a zero p-value indicating it's significant, and the adjusted R-squared for that model is high, 96%. In terms of AB, we do believe costs have risen. The p-value in that case is not as strong, but we do see that there's a rise in accident benefit severity due to the reforms. And I think at that point, I'm going to pass it over to Chris.
All right, great. Thanks, Paul. All right, so let me go over the kind of historical COVID-19 data and how that's impacting frequency, and then also touch a little bit more on this new normal and consideration for insurer rate applications. Go to the next slide, please. So this slide is similar to the slide I presented before, but it's catered towards COVID-19. So we have the frequency for each coverage on the right-hand side, and that's kind of showing the dramatic impact the pandemic had on claims frequency. We see large dips in all major coverages except for comprehensive. And since our goal is our goal of our trend analysis is to kind of focus on the underlying signal. And since we're focusing on the signal, we don't want these one-time occurrences to really influence our trend rate. So our methodology kind of either excludes that data from consideration or quantifies it. So we do separately quantify that impact, although the base of our trend report, we tend to exclude the impact of the frequency. We do that mostly for convenience. In our appendices, we actually do have additional models where we quantify the impact of the COVID-19 pandemic on claims frequency. And we do that by including an additional mobility parameter, kind of looking at the average mobility of Albertans during each time period here. And insurers could use a similar approach or some other approach to adjust their data to pre-pandemic levels. And that's kind of what we recommend insurers do is, first we adjust their historical data to pre-pandemic levels, and then separately making another adjustment to reflect the perspective period. So as I talk about the perspective period, I think there's a lot of uncertainty around there. If we go to the next slide, please. So the pre-pandemic level, that first adjustment I was just speaking of, that may not result in a reasonable estimate for the perspective period, especially based off of the kind of data we're seeing to date. We've heard a lot about this new normal, and the new normal is really synonymous with both with more hybrid and remote workers, which is kind of driving conditions and behaviors worldwide to change. So we believe an adjustment to reflect that expected impact of the new normal is warranted. The difficulty really is determining when this new normal began, and what's the right number for an adjustment. And there is a continued push for employees to return to the office. So even though we're seeing this dip in frequency right now, will this continue for the prospective period? So it's very uncertain. There's no real perfect answer, but based on the mobility metrics available, we think that the second half of 2022 may be a good potential starting point, and it could potentially indicate that that there's not going to be this return to this full return, at least, to pre-pandemic levels. We did receive some pushback on this suggestion from various stakeholders, and that specifically that the 2022-2 frequency level is not representative of the new normal. And I just really want to highlight that we recognize that there's a lot of uncertainty here, and that we are working with data that's on a lag. And we think insurers should consider, their own data and the most recent experience available at the time of filing in order to determine an appropriate new normal adjustment. For example, they can look at monthly frequency metrics, and it's difficult if there's not a lot of credibility to their data, but we're looking for some kind of data-based approach to support an adjustment that can be reflected as part of this, as part of these filings. On the next slide, we present data from Google showing the total amount of time Canadians spent at home, and this is the mobility data that I'm referring to, and it differs by province, but we're showing Canadian-wide data because it's pretty similar. And really, the Canadian mobility has kind of returned or stabilized. It's near pre-pandemic levels, but the thing that we want to get across is that it's stabilized beginning in 2022, and that stability, it appears to support the idea of a new normal beginning in the second half of 2022, and is really the basis of our suggestion of using, that may indicate at least an early indicator of where frequency levels may go in the future. All right, for collision, the next slide here, shows kind of our the trend adjusted frequency. So let me just break this down a little bit. We showed the change in frequency level between the pre-pandemic experience and the 2022-2 data observation. So that last data point we have in the model. The blue points are the trend adjusted data observations. So Alberta, there's a 0% frequency trend, so it's equal to the actual observations. And then we also show Ontario here, but we dress those up for the historical frequency trend, and then the horizontal blue line represents the kind of pre-pandemic frequency level. And then we take the 2022-2 data point and trend that forward to the prospective period and just show what that difference is. And the thing we're trying to highlight here is that there is still this very large gap between the trended pre-pandemic frequency level and the observed frequency level during the second half of 2022. And this gap is present across Canada, and that's really why we think that, you know, some kind of adjustment needs to be made, and you know, it needs to be reflective of the insurer's own experience, and you know, at the time of filing, there needs to be some kind of assumptions made, and that should be well documented and thought out as part of the filing. All right. And with that, I will turn it over to Paula.
Paula and Chris, I'm just going to we have about 7 minutes left, just to let you know, friendly reminder.
This is the last section. So I think
Perfect. Thank you.
Thank you. Yeah, so we could scoot over 2 slides to the profit section, the next slide. So the profit here, as I said at the introduction, we wanted to talk about our loss trends, factors influencing the loss trends. And here on a summary level, we want to look at profit. And this is a look back at profit, not a forward look. And certainly what we're seeing is that during the pandemic period, during 2020 to 2022, there were exceptionally high profits, more so for 2020 and 2021, well in excess of the board's guideline, 7% of premium provision. We suggest that the profits, while they have been certainly higher during the pandemic period, looking back into the history, in general, on average, companies have not achieved the 7% target profit provision that insurers would include in their rate application. So there is a history of that, which changed during the pandemic, became a little closer in 2022, and it's also uncertain what 2023 will be because of the rise in inflation. How will that go? Will it stabilize? And also the new normal that Chris just talked about, this lower frequency rate that we're seeing in the second half of 2022, when we think the impacts of COVID have really kind of changed to a new normal. So how will that affect 2023 as it unfolds? So there's uncertainty there. And in terms of stakeholder comments, there's some suggestion that they think that companies have earned higher profits in the past. We don't necessarily agree with that. And there's also a comment that insurers earn 7% of premium, and in addition, earn investment income on their capital. And that is true. That is the case. That's not new. That's just perhaps just a statement that was made. So we're not disagreeing with that. But it's also not new. That's been since the profit provision was in place. I want to move to the next graph just to give you kind of a bit of a history. So loss ratios are really the driver of whether companies will make profit or not. And we have presented here just a history of the loss ratios broken between or split between the basic coverage, the additional, if you will, optional physical damage coverages, and then total and aggregate. So the basic coverage, the loss ratios are certainly well above our red line, which we're indicating as where we believe the loss ratio should be to achieve a 7% profit provision. So it's only over the more recent period, 2020, 2022, where the loss ratios are hovering below the red line for basic. In contrast to that, for the additional coverages, with the exception of a few years, the loss ratios have been low enough for the companies to be achieving a profit higher than 7% for those coverages. But then when you look at in aggregate, It's heavily influenced by the basic coverage. So in total, for the majority of the past over this horizon that we presented, companies were not achieving the 7% profit, but it was achieved during the most recent 3 years, 2020 to 2022. And then we'll move to the last slide. And this is a quick snapshot for you looking back. What profit level, how does the profit level achieved? And this is an industry aggregated number. How does that compare to the 7% profit provision? So the loss ratios, as you can see for each of the 5 years presented here, they decline significantly with from the 80s for 2018 and 2019 down to the 60s for 2020 to 2022. And in addition, we have a measure, if you will, of investment income used through or derived through what we call a discount factor. The lower that factor is, the more investment income that is attributed. And if there is less investment income, the discount factor will be higher. If you look at 2022, the factor is relatively high at 0.998. Now, 2022 was an unusual year with the stock market falling dramatically, which has since recovered in the early part of 2023. But as a result of that, the investment income that insurers were achieving to operate in Alberta, private passenger auto, was quite low in 2022. So that influenced the profit level. We add a provision for the health levy. We add a provision which is reported PISA expense ratios, and do our calculations to estimate a profit provision. So for 2018, 2019, and 2020, I'm sorry, not 2020, 2018 and 2019, companies were not achieving the board's 7% profit provision, but certainly in 2020 and 2021 they were. These were not intended profit provisions by insurers. These would be unintended, if you will, windfall due to the pandemic, a loss ratio being lower than anticipated. And in 2022, we see marginally higher than the 7% at a 9% provision, but some of that is influenced by the very nominal return on investment rate for 2022. So that wraps up our report. We want to thank you for the opportunity to present it today.
Thank you, Paula and Chris. We're going to now move to agenda item number 3 and hear from the AIRB's consumer representative, Matthew Wazalowski.
Excellent. Thank you, Jamie, for that introduction. As Jamie just said, I am Matthew Wazalowski, and I've been the consumer representative for the Alberta Alberta Insurance Rate Board since September of 2020. I'm pleased to present my report today at this meeting and provide you with my observations and thoughts. It is my role and it's my responsibility to ensure that Albertans have a voice at each of our board meetings, as well as here today. So I will be sharing with you the highlights of the survey and focus groups that we conducted to collect information and sentiments from Albertans about their automobile insurance. If I could go to the next slide, please. And next slide again, please. Right, so when we talk about consumers' expectations, I'd like to start by ensuring that we have a common understanding. To operate a vehicle in Alberta, legislation requires that drivers carry a minimum limit of basic coverage, which includes third-party liability and accident benefits coverages. Of course, we all know there's optional coverages, but the basic coverages are third-party liability and accident benefits. And given the automobile insurance for basic coverage is mandatory in Alberta, consumers have certain expectations about insurance. And these are that insurance is affordable. They expect that premiums are equitable, accurately aligned with the risk profile of the driver and the cost to provide coverage. Insurers manage costs to avoid unexpected increases at renewal, and that premiums changes are clearly explained by insurance professionals, and options to reduce rates are explained and provided to consumers. They have an expectation around stability, that insurance premiums are stable over time, allowing for inflationary adjustments. This will ensure stability for Alberta drivers when budgeting for their automobile insurance. They have an expectation that only drivers who have a change in their risk profile due to convictions or claims will see significant increases. And they have an expectation around accessibility. They expect that insurance is available to all drivers regardless of their risk profile, that there is in Alberta a competitive marketplace where drivers have options of insurer and of coverages to meet their specific needs, and that insurers provide full coverage to all drivers without placing obstacles or hurdles in their path as they try to purchase insurance. And last but not least, certainly consumers have an expectation of customer service. Insurance professionals, they expect that insurance professionals are well educated and trained to assist consumers in understanding their coverage needs, their changes to premiums, and ensuring they are adequately insured. If we can go to the next slide, please. So, to assist us in achieving our understanding of consumers' perceptions of insurance in Alberta, each year we do a consumer perception survey. And in this year, we collected data to assess consumers' awareness and perceptions about insurance rates over the past year, as well as some other factors. Consumer feedback was primarily obtained through telephone surveys and online panels marketed via social media. The surveys included both quantitative and qualitative questions that collected data and allowed us to compare that data to previous years while ensuring that the voice of Albertans was heard. All participants had to be at least 18 years of age, responsible for purchase of their household's vehicle insurance, and their vehicle had to be for on-road use. Also, all participants had to declare that they do not work for a marketing and research firm, a news media, or the insurance industry, or the Office of the Superintendent of Insurance, or the AIRB. And last but not least, we conducted focus groups this year as well. We held 2 online focus groups, with each group had separate target demographics. We had ages 18 to 34 and ages 34 and up. We ensured that our participants fairly represented the entire province geographically. Each focus group, the attendees participated in open discussions on their opinions on automobile insurance in Alberta, and were asked several questions on this topic. If we can go to the next slide, please. So just a little bit on the demographics of the survey. You can see the slide is quite self-explanatory, but I do want to point out that this year we had 941 participants, with 639 participants responding to an online survey, and 302 respondents were interviewed via a telephone survey. Community, gender, age, and years of driving experience was monitored to make sure that the survey represented all Albertans. And if we could move then to the next slide. So one of the big issues is whether or not consumers feel that their automobile insurance premiums are fair and reasonable. And so indeed, we ask that question. And we know that affordability is top of mind for Albertans. And there is sensitivity to price changes in mandatory insurance purchases like automobile insurance. So when respondents were asked, do they agree with the statement, automobile insurance premiums are fair and reasonable, many consumers indicated a low agreement. In this past year, in 2023, we saw a slight drop in those respondents who have a high level agreement, down to 19% from 25% in 2022. When asked, do you have any comments or concerns with automobile insurance in Alberta, 71% said insurance rates are too high, costly, expensive, and keep increasing was the general sentiment. We can go to the next slide, please. And I think this particular slide is quite interesting, and the observations were quite interesting, because while the change in average premium was only 0.6 in 2022, well below the rate of inflation, there was certainly a perception that insurance rates had been increasing and were much higher. And it caused me to stop and think about this and say, well, why is there such a perception of high rates and increasing rates? And I think it's threefold. One is that there are other cost pressures in their lives because of inflation that is causing people to look at their insurance. Another one is been fueled by media reports and not always accurate reports on the cost of insurance, as well as this particular issue of affordability and insurance premium being highly politicized in the recent past. So that's my observations. If we can go to the next slide, please. So now we talk about the awareness of factors contributing to rising insurance premiums. And I have to point out again, the average increase was only 0.6%. But having said that, we know that consumers are experiencing overall affordability issues, particularly those individuals who made claims. It is critical that they may be made aware of the factors contributing to automobile insurance increases. With a much better understanding on the factors, consumers' opinions on the fairness of premiums may change. So when asked, were you aware the following factors contributed to the rising cost of insurance, many Albertans demonstrated a high level of awareness for some of the factors contributing to increases. However, other factors were not as well known. So when reviewing the results over the last 4 years, there's a slight change in responses. We do see a significant increase in the awareness of the role of distracted driving and automated features play in the cost of insurance. And I think that's because that's been well publicized in the media. We can go to the next slide, please. For me, this number was quite concerning when we look at the unexpected increases through claims and being conviction-free. So 59% of respondents indicated someone in their household experienced a premium increase, although they were claims and conviction-free. This is similar to 2022. Survey respondent subgroups who were significantly more likely to have experienced unexpected increases in vehicle insurance rates were those where they had no claims and convictions, indicated they were either from Calgary or were in an age group of 18 to 34 years of age. And as we said, there are other factors that can increase insurance premiums. But if we go to the next slide, please. one of the things we wanted to do was ensure that people understood that there are actions that could be taken to reduce premiums. So we evaluate consumer awareness about options for reducing their premiums with the question, before today, were you aware the following actions could reduce your vehicle insurance? Awareness has increased in 2023 on all actions, and in particular, a large increase was noted in shopping the market. All other factors, another factor we know can influence automobile insurance is the choice of vehicle driven. This is something the AIRB speaks to consumers about, and I can tell you that we discussed this in some degree in the focus groups, and it was surprising to me the number of people who said, oh, I know if I buy this vehicle, my insurance will be higher. But did that influence your decision to purchase that vehicle? Oh, no, I still bought it anyways. Let's go to the next slide, please. Shopping the market. So we all know that Alberta has a competitive insurance market with each insurer providing unique coverage and pricing options above and beyond the basic insurance. The survey asked, at any time in the past 2 years, have you sought competitive quotes? The results indicated more consumers indeed sought competitive quotes in 2021, and that the numbers have dropped since then. In 2023, only 54% of the respondents sought competitive quotes, as compared to 74% in 2021. And I would suggest that this is probably, the drop is in line with the fact that insurance only went up on average 0.6%. It's interesting to note that respondents who indicated that they were significantly more likely to have sought competitive quotes in the last few years were those individuals in the demographic of being under the age of 55. If we can go to the next slide, please. We did also talk about customer service, and this continues to be an interesting point. Consumers that experience increases in insurance premiums were asked if they contacted their broker or agent for an explanation. Those that indicated they had contacted their broker or agent were also asked how they felt about that explanation that they received or were provided by their broker or their agent. Survey results indicated that the information brokers and agents provided was not sufficient. Of those respondents who experienced rate increases in 2023, 62% contacted their broker or agent for an explanation, and only 24% of those consumers felt that they received a satisfactory explanation. We also note that the increase in satisfactory explanations in 2023 needs to be considered in light of and along with the decrease in the number of respondents asking for an explanation. Of note, respondents in rural Alberta were significantly more likely to have contacted their agent or broker for an explanation or changes in premiums. We can go to the next slide, please. Consumers were asked, were you aware driving convictions could affect your vehicle insurance premiums to the extent that they do? And each year, this number really surprises me. 66% said they were aware that driving convictions could affect their premiums to the extent that they do. And this is down from 70% in 2022. And I'm in today's day and age, I'm baffled that people still don't understand that how they drive and their convictions can impact the rates. And that would suggest that both insurers, the industry, and the AIRB need to do more education to help consumers understand that their driving behavior affects their premiums. And the consequence of that, I think, would mean for safer roads. If we could go to the next slide, please. Another thing that we asked them was about their awareness of direct compensation for property damage. We know as an industry that DCPD was introduced as part of automobile insurance reforms in October 2020. So when we ask consumers if before the day they were surveyed or the day they were in the focus group, had they heard of DCPD, 39% of respondents were familiar with DCPD, and that's only a 4-point improvement over last year. This indicates that brokers and agents need to do more to educate their clients about the coverage they purchase. Again, interesting, when we look at the demographics, those who responded more likely to have heard of DCPD were those individuals over 35 and in the male demographic. So most of what I've said previously is related to the surveys that we conducted online and the telephone. I'd like to turn my comments now for a moment to the focus groups. And if we could go to the next slide, please. So as mentioned at the outset, we conducted 2 focus groups. We did this virtual online. And of the groups that the people we talked to in the focus groups, there was a shared skepticism about the insurance industry's practices. Some consumers did not truly understand the purpose behind certain rating factors, like territory came up quite regularly. The younger focus group was more concerned about privacy when it comes to user-based insurance or pay-as-you-go products that may use telematics, or that would use telematics. Overall, there was general frustration with the perception of rising insurance costs, and consumers feel that there's not enough support to understand their options and their rights. You can go to the next slide, please. So my observations in reading through the survey results from the online and the telephone surveys and the focus groups are that inflationary pressure remains a serious concern for consumers. There's a high percentage of Albertans who do not feel that their premiums are fair and reasonable. Consumers are frustrated with unclear answers from the industry about why premiums are increasing. And this frustration and confusion has created significant skepticism about the insurance industry and its practices. There is much more to do to educate Albertans about automobile insurance. And the AIRB has and will be wrapping up consumer education activities this year, including launching a social media channels. And we hope to see improved results in next year's surveys of the consumers. And so, Mr. Chair, that would be my report and my comments for this year.
Great. So on behalf of the AIRB, I would like to thank Matthew for his presentation and report on consumer perspectives, who are key stakeholders in the work that the AIRB does. Now we will move on to industry stakeholder presentations to hear comments on Oliver Wyman's review of industry experience. Each presenter will have 20 minutes, including times for questions the board members may have. I will give you a warning at the 8 minutes remaining, so you can have a chance to wrap up and leave time for questions. So now we will move on to agenda item number 4, where we have the Insurance Bureau of Canada representing IBC are Aaron Sutherland, who is Vice President, Western Pacific, and Hannah Baydoun, who is Manager of Policy.
Thanks so much, Mr. Chair, and thanks to all of you for making time for us to present with you today. Everyone can hear me okay? Open restroom. So as mentioned, I'm Aaron Sutherland. Today is Hannah Baydoun, our policy lead on the auto insurance file. And if you can go to the next slide, we're going to talk a little bit today about the state of the auto insurance industry in Alberta. And then I'm going to turn it over to Hannah, who's going to go over some of the loss trends factors that we've seen emerging so far this year, a bit of commentary on the profit provision and some of the recommended next steps. And we're going to try to do this to make sure we do adhere to the scope of the conversation today and don't vary too far outside of that. Although, of course, all of this conversation relates to the rate pressures our industry is under, and so of course we're under a rate freeze. First and foremost, I think if we want to see a healthy marketplace in Alberta where we can see improved choice, value, and affordability for consumers, first and foremost to that, we do need to see the industry able to account for the significant pressures that have been coming down both last year and this year. And I say last year because when the rate freeze was brought in January, all of the pressures that Oliver Wyman and others identified last year, many carriers were unable to account for those in their claims today, let alone the new pressures and emerging pressures this year that Oliver Wyman and others have identified as well. But so if we go to the next, you can probably skip 2 slides. Just in terms of where are we today as an industry, I think the consumer rep hit on this quite clearly. The reforms brought in by government in late 2020 really have helped stabilize premiums for consumers. Over the past 2 years, they've changed by just 1.7% annually. That relates both to the impact of those reforms as well as, of course, the impact that the pandemic had on consumer driving habits. And, again, similar to what the consumer rep had said, it's the public narrative on the auto insurance files differs greatly from what's really going on in reality as it relates to consumer premiums and the prices drivers are paying and what's really happening and the trends there. And so I think we as an industry clearly have more to do to better inform our customers about that. And we'd welcome the opportunity to work with all of you folks as well. But of course, a lot of those things are sort of looking backwards. So where are we going forward? And if you go to the next slide, this is going to be a lot of what we cover today and what we've seen from Oliver Wyman. We continue to see persistent inflation, lingering supply chain issues, and real strained labor market challenges that are putting pressures on auto insurance claims costs. We have seen significant increases in the price of vehicle repairs and replacement spend. Anyone with a car has likely seen this. Spending on automotive repair parts and repairs has increased by double digits, about 13%. The price of used vehicles is way up, 33%. New vehicles continue to increase in price. Those are up 18%. That is putting significant pressure on the industry moving forward. On top of, and this is sort of one that we're highlighting because it's a relatively new pressure that's emerged over the past few years that we didn't see as much of previously. And this is on top of the continued challenges we see on the bodily injury claim side and the significant pressures we see as a result of Alberta's legal framework. And if we can go to the next slide. And so, the industry's expectation is that the rate pause will be lifted in December. It's clear government is going to take some kind of action to address some of the pressures in the system to improve the price consumers are paying. We're keen to work with them as to what those might be. But once the rate pause is removed, it really is paramount the carriers are able to address the cost pressures they face in their rate setting moving forward. And it's really paramount that they're able to use their own individual experience where reasonable in that. And so we continue to suggest that the AIRB review insurer rate filings based on the reasonableness of those filings rather than deferring to their own consulting actuary. And if you go to the next slide, I think this is something that Oliver Wyman would even agree with himself, that, really the way actuaries work, no two are going to think exactly alike, but no two are necessarily going to be wrong because no one has sort of the golden compass or the glass mirror that's going to tell them exactly what's going to come down in the next year or so. And so it really is important that carriers, they all have their own experience, they all have their own position in the marketplace, they all have their own scope of practice as it relates to the consumers that they have. And it really is paramount that they're able to put forward what they believe is reasonable, and where it's justified, we believe that the AIRB should be reviewing their applications based on the reasonableness of those filings themselves. And if you go to the next slide. The last thing I'll say, and I know the grid is relatively outside the scope of this conversation. The only other thing I would flag to you folks today is that we continue to see significant challenges for consumers as a result of the grid framework in Alberta. It's costing good, safe drivers more and more every year. And with the rate freeze and the knowledge that this annual review process will not be addressing grid-based premiums this year, we can expect the grid to continue to grow, to continue to cost safe drivers more. And that appears to be running in direct conflict with government's stated objective here, which is to see good drivers pay more affordable premiums. The grid doesn't allow for that, and I would strongly encourage, whether it's part of this process or another, your board to take a strong look at the grid and identify what changes can be made to ensure that we don't continue to see safe drivers subsidizing bad drivers here in this province, because it continues to cost them more and more. And so with that, I'm going to turn it over to Hannah Baydoun to walk through some of the more specific cost trend pressures that we've identified here at IBC.
Great, thanks, Aaron. Just next slide, please. Perfect, we can skip over this one. So I'm going to give us an overview of the loss trend factors. So this year, IBC retained Dr. Ron Miller to review the trend factors that were presented in Oliver Wyman's report. So both Dr. Miller and Oliver Wyman projected that several coverages, particularly those related to injury claims, are going to increase considerably over the next year. So as we can see in this table, Oliver Wyman's projected bodily injury future loss trend rate is 5% and Dr. Miller's is 4.2%. So a similar trend revealed in previous reviews as this one is that both actuaries are once again projecting double-digit accident benefits future trend rates at 11% and 8.8%. So these selections indicate that under the current product, injury claims costs will continue to rise significantly. And we're looking forward to speaking to the AIRB board next month to discuss our proposal that we believe will provide greater choice and care for consumers while also reducing the coverage that they pay for their auto insurance. So shifting to vehicle damage coverages, Oliver Wyman and Dr. Miller, just previous slide, thank you. So Oliver Wyman and Dr. Miller both project relatively modest future trend rates for vehicle damage coverages. But unlike the two previous reviews, Oliver Wyman no longer suggests that insurers consider the vehicle repair or the vehicle maintenance and repair cost CPI data in Alberta at the time of the rate application. So while we are seeing the general inflation rate subsiding, there still remains inflationary pressures for insurers who consider to see quite sizable increases in the cost of vehicle repairs and replacement. And this is due relatively to the longer term impact of supply chain disruptions that we've seen over the course of the pandemic and pent up consumer demand. So we believe that insurers should be permitted to consider real-time Statistic Canada data elements in future rate filings to allow them to capture changes in CPI and if they believe it's necessary based on their individual experience. So next slide, please. So as I've noted, we believe that there remains pressure for Alberta's insurers, particularly on the vehicle damage side. And we've listed some of the StatCan data elements here that we believe insurers should be permitted to consider during their rate filings. So those include the value of new and used vehicles, vehicle parts, accessories, and supply costs, private passenger vehicle lease costs, and the rental of passenger vehicle costs as well. So giving insurers the option to consider these data elements in their rate filings will help to ensure that they can accurately reflect inflationary pressures that persist on the vehicle damage side. So next slide, please. So I'm going to talk a bit about the profit provision now. So we can go to the next slide as well. So writing PPV auto insurance in Alberta has been relatively unprofitable for much of the last decade for the province's auto insurers who've been paying out considerably more in claims costs, operating expenses, and premium taxes than they collect in premiums and investment income. And so while the current profit provision benchmark is 7%, the Alberta private passenger vehicle auto insurance industry almost never approaches this level, let alone exceeds it. And so the problem in Alberta's auto insurance market today is that, while it's been very unprofitable, any changes to the profit could threaten consumer choice and competition, which is already at stake right now. So IBC believes that, limiting the ability of insurers to work towards longer term and sustainable profitability really runs counter to Alberta's inherent free market values. And this would really have a chilling effect on insurers who are looking to expand in the province. And, such a decision would really impact insurer choice to grow or continue to operate in Alberta, which would of course negatively impact insurer capacity in the province. at a time when we really need to attract additional capital and increase competition in the market today, so that we can ensure that the consumers have more choice. And so today, under the current environment that we're in with the rate pause, we've already seen 2 companies indicate their intention to exit the auto insurance market. And this is due to their inability to obtain the premiums needed to cover claims cost pressures. And one of those companies has actually already exited the market here. And this has left 16,000 drivers without coverage. And to compound this issue, unfortunately, is the fact that there are fewer auto insurance providers in the province today than there have been in previous years. So to put this into perspective, Alberta has roughly double the population of Atlantic Canada, and there are more carriers offering auto insurance coverage in Atlantic Canada. So it's clear here that the viability of Alberta's auto insurance system is really at risk, and any changes to the profit provision would make matters far worse and could send a negative signal to insurers who are considering expansion in the province. And finally, of course, the province's history of volatile and severe weather events really makes it a high-risk province, and there's no evidence that this is going to improve. So the unpredictable nature of the severe weather events really just makes it a quite difficult environment and really warrants a higher profit provision for Alberta. So finally, what I'll just say is, IBC agrees with maintaining the 7% profit provision as stated in the overwhelming report, and the factors I've highlighted today really warrant a higher profit provision in the province, as insurers really rely on greater capital funds and profit margin to ensure the availability under such adverse scenarios. So next slide. So as we mentioned, there really remains significant uncertainty for Alberta's auto insurance system today. While we're going to speak to our more recommendations at the upcoming board meeting in September, there are a few actionable and attainable steps that we believe the AIRB can take to help alleviate system cost pressures that are not sustainable. So next slide. So as Aaron mentioned, we believe that the AIRB can take steps to realign the grid framework to ensure its intent of ensuring that new and inexperienced drivers have access to affordable entry-level premiums. And once the rate pause is removed this year, the AIRB should consider permitting actuarially justified rate changes to ensure that insurers can collect premiums to cover the claims cost pressures that persist. And finally, it's quite crucial that the AIRB educate government on system cost pressures that have been identified in this review by both Dr. Miller and Oliver Wyman in the report. And we believe this can help expedite the removal of the rate pause. The system cost pressures that both actuaries have identified, along with the persisting inflationary pressures that we're seeing on the vehicle damage side, should be highlighted to government and can, to help them better understand their impact on claims costs, consumer premiums, and finally, the viability of Alberta's auto insurance market. So thanks everyone for having us. IBC appreciates the opportunity to present our annual review submission, and thank the board for having us here today. Aaron and I are happy to answer any questions that you may have for us.
Well, thank you, Aaron and Hannah. And I now will invite any of our board members to indicate if they have a question for IBC. And I think Patricia has a question. Patricia?
Yeah, sorry. Technology, gotta love it. I thought I was the only thing melting, but apparently my computer is too. My apologies. You recommended permitting actuarially justified rate changes in 2024, and I appreciate your presentation today, but we remain concerned for affordability of auto insurance and the impact of individual policyholders. What will your members do to ensure affordability of auto insurance once rate increases are permitted?
Yeah, thanks for that question. And apologies, as you probably heard during my remarks, I'm fighting a bit of a cold, and I'm probably the only person that can catch a cold while we all melt here in the heat. So I blame my child daycare. Carriers price risk in a sense, right? And so we are seeing significant increases in the cost of that risk in this province as it relates to auto insurance premiums. Some of those trends are true across the country and internationally. Think about vehicle damage costs, the supply chain backlogs we're seeing, the labor cost challenges we're seeing. that pressure on vehicle and property damage, that occurs right across the country. But there's, bodily injury pressure in Alberta that is relatively unique and has escalated dramatically. Things like the fact that the average bodily injury claim in Alberta has doubled in the last 10 years. The fact that Albertans are 4 times more likely to sue following an auto insurance accident than other Canadians. A lot of that we believe to a preponderance of and buildup of the legal community in Alberta as other provinces have brought in restrictions there. Moving into this province, you're seeing their ads on billboards, on bus stops everywhere, trying to attract clients. It's understandable why individuals and consumers, view a cash settlement as something they want to strive for. The preponderance of that is driving up the cost of auto insurance for everyone. So, and the challenge is, as we see those pressures come down, if carriers can't account for them, it creates a very unsustainable marketplace. And it really puts the competitive market at threat. And I think we've seen that so far this year with some carrier actions that have come out in the marketplace. And I think if we aren't able to get to a healthy marketplace where carriers can reflect the pressures they're seeing in their rates in a competitive manner, that competitive market is at threat. So is there more the industry can do to educate consumers about how things work, the benefits of shopping around, things like that, and how that can, discounts and all of that can improve affordability? Absolutely, and it is something we need to work at. Can carriers also look to things like capping, in terms of how they set their rates and pieces like that to make sure that, certain segments of drivers aren't seeing undue price increases or, dramatic rate increases? Absolutely, and I think they do that, and we see that requirements in some of the AIRB's previous requirements in the rate filings. Take your file and use requirements that had capping thresholds and things like that for individual consumers. There are different policy tools and levers that I think we can use and you can use to achieve some of those objectives while still allowing rates to return to their actuarially justified levels. Because truly, if we don't allow for that, if we continue to limit that, that is where it puts a lot of strain on the viability of this industry, and it really threatens the ability of the industry to provide the products it does for Alberta's drivers. And as we see that strain, that means less choice, less competition. And when you see that, you ultimately have people paying more for their auto insurance, which isn't something anybody wants. So, sorry, that's a long-winded answer from me. I'd suggest the AIRB has tools. I think there's more the industry can do. I think we're also very keen to work with you and government proper to identify reforms that could help, pull cost pressures out of the system and improve affordability for the long term.
Thank you for that. For obvious reasons, I think we remain very concerned about the impact on consumers on renewals. And I'd love to get more detail on that. But in the efforts of keeping us on time, Mr. Chair, I'll say thank you very much for the information you've provided and for your presentation today.
Great. I don't see any other questions. So once again, thank you, Aaron and Hannah, for your presentation. Now we're actually running ahead of time. I would say about 15 minutes. So we'll take a 10-minute break just to refresh your beverage, stretch your legs, and we will start, I'll say at 9:40 our time here in Alberta for the next presentation. So enjoy your brief break and we'll see you soon.
Thank you, everyone.
Thanks, folks.
Welcome back to those of you returning and those who are just joining us to hear from our industry stakeholders. We're going to now move on to agenda item number 5. We have the Facility Association represented by Saskia Matheson, President and CEO, and Philip Gosselin, VP Actuarial and CRO, and Derek Tupling, VP Government Relations and Communications. And I'll turn it over to the facility.
Thank you, Mr. Chair. We're very, very pleased to be here. I'm going to do, even though we did a technical check yesterday, I always like to do a sound check and make sure you can hear me well. So
we're good. Yeah.
Thanks very much. We're very pleased to be here today. We appreciate the opportunity to present to the Alberta Rate Board. Facility Association does make a point of appearing each year and participating in what we think is a very important open consultation on the issues. With me today, as you've mentioned already, are our VP of Actuarial and Chief Risk Officer, Philippe Gosselin, and also our VP of Government Relations and Communications, Derek Tupling. I'm Saskia Matheson. I believe I was at the very first 2004 open meeting on from the board, and so I applaud the tradition of opening for the conversation to the industry on this and all interested participants in this important topic. If we could go to just slide number 2 for a moment, thanks. Today we don't have a long presentation, we have a fairly brief presentation, and so we're simply going to, as we've already done, go through the introduction. So that'll be quick. A quick overview of the Facility Association. I know the board is familiar with the organization, but because we are a unique organization, we try not to miss the opportunity to bring that back and talk about the unique perspective that the Facility Association has on the questions at hand. We'll give a quick overview of the Facility Association market share in Alberta, and then I'm going to turn it over to our Vice President of Actuarial, Philippe Gosselin, to talk about our topics in the loss trends and subjects for today. That'll conclude. I think we'll have plenty of time left for questions. This is, as I say, not a long, in-depth, complex presentation, but absolutely an important one. Could we go to the next slide? I've mentioned who's here, so we're just going to go straight on to the next. This is one of the items I like to stress with the Facility Association is, in fact, that we are a unique organization, and that gives us a slightly different perspective on the questions that you are looking at and on the issues that you are addressing. Facility Association is an organization that is created by legislation, and there is legislative basis for the organization in all of the jurisdictions in which Facility Association operates. To that end, Facility has a purpose, and that purpose, again, is unique in the industry, which is to ensure the availability of auto insurance to owners, lessees, drivers of motor vehicles who are eligible, and importantly, who would not otherwise be able to obtain that insurance. And as we say, the way that we do that is we have a number of mechanisms that have developed in some senses organically, but always with links through the years to address the challenges of availability in the market. But that is our primary lens, is the fact that we always come back to this question of how will the changes, how will the issues of the day, how will, whether it's product changes, pricing, market players, how will that affect the ability of consumers to buy and the willingness of insurers to sell, and those two things together working within the legal framework of the specific province in question. Facility has a fair amount of expertise in a number of unique areas. Some we're not going to talk about today, things like the grid, but we like to keep the door open to have those conversations because, again, given our position in the market, we have some insights that are difficult for other parties to obtain. Let me go on to the next slide. Just an overview, and again, we're talking today, I know, around private passenger rating in Alberta, the loss trends. And within that regard, if you see the core, the historic base of what Facility is, where Facility Association operates, we refer to that as the farm, the Facility Association residual market. It still confuses folks. This is not anything to do with ranches, cattle, horses on the prairie. This is our residual market core business. It is where Facility Association writes at its own rates. We have a very, very small, come back to that, presence in this market in Alberta. We also obviously offer a whole range. We are required by law to write all those who are required to obtain insurance, which means we have rates for every kind of vehicle that exists and is required to be insured on the roadways. If you can think of it, we have an insurance rate and policy for it. Outside of that, and obviously a much larger presence in the Alberta market, are the risk-sharing pools that Facility Association operates. There are a number of pools of slightly different configuration. We keep trying to get them closer together for the sake of simplicity, but in each case, they do reflect the unique needs of the province jurisdiction in which they operate. So of course, in Alberta, we operate 2 pools, legislatively the same, functionally apart, the grid and the non-grid pools. In addition to that, and this really, I think, speaks to the way the markets have changed over the last decades, which is the Facility Association has accountability under its plan of operation for the provision of the underwriting information plan. So that collection and distribution of information about the history of insurance individuals, their claims, their background, their driving, to allow the fair and accurate premium generation in the market. And so in this area, FA has, over the years, been brought into, sometimes unwillingly, but always with good governance, into the area of management of data, ensuring the privacy and accuracy of personal information, and the governance framework around that. And that then leads within this outer accountability, which is around reporting and data. And again, this is both to our stakeholders. We also provide insight data information to many of the regulators, yourselves included, around parts of the market aspects that we have insight into. So if I could move just to the next slide, and you can see the overview of the Facility Association market presence. If you look at this slide and you see the blue bar that you can see a little bit in the bottom of the 2004 year, and is well, we'd have to really explode the slide up to a large base for you to see that number in the 2024 bar. That is the market share that Facility Association residual market, so people written on an FA identified policy at FA rates in private passenger, is in 2024, which is a very small group of vehicles, both in some cases right-hand vehicles. In other cases, this is what is permitted to be placed in the residual in the farm, which is, as I say, set by the rules of the legislation and regulation, and very small. Over top of that is the back and forth between the 2 pools that FA operates, the grid and the non-grid. You can see that at its start, we had a large number of vehicles in those 2 pools, specifically in the large grid pool. And over time, as the market adjusted and understood the data and the market itself stabilized, we saw the positive move downward towards an overall number that was fairly small and steady. In the last few years, we have seen an increase in those numbers. Now, while we're not talking about the grid today, one of the points that we do want to make is this becomes a good watch metric to see how the market is reacting. So in and of itself, it is an indication of business that either hits the grid or cap, or companies perceive that their rate is insufficient to cover it. And so it becomes a really powerful and useful litmus test of how the market is reacting to its views on profitability. And that is one of the reasons why I know the board looks to us to provide the data, and we are happy to provide this information in order to keep a watch on an ongoing basis of where we sit in that regard. Having said that, this is And it leads us really to the discussion around the loss issues. And I'm just going to turn this over to our VP of Actuarial, Philippe Gosselin. And I will say you will hear in detail and in far more complexity than I can certainly manage. But I think the message remains pretty consistent from facility over the years, which is we are looking to ensure or to keep a watch on the availability of insurance in the market. And the more options that insurers have in order to predict the future through their own lens from their own specific unique perspective, the more appetite there is, the more price points and options there are. And in our experience, in our view, the healthier the market is maintained, and therefore the smaller these bars are and the less in terms of numbers that we have to watch. So in that regard, I'm going to turn it over to Philippe to take you through the next few slides. Thanks.
Thank you, Saskia. If we go to the next slide. So actually, I don't intend to go into too much details of the benchmark. I think it's been said previously in this meeting that having many different actuaries looking at the same data, you will come up with many different possible models of frequency, severity, and loss costs. And at the end of the day, the ultimate selection of models by the insurers in developing their own rate is a matter of judgment and professional interpretation that, again, will differ among actuaries. I think the previous presenter showed a table comparing their selection or selection of one actuary versus the Oliver Wyman benchmark. In our written submission, you also have a table summarizing our own selection versus the proposed benchmark. I don't intend to comment on this because, again, I truly believe that it's a matter of judgment and professional interpretation. And Saskia said it. I think we've been pretty consistent in our messaging over the years, but I would like to go over it once again. We do believe that rate making is obviously an exercise of predicting the future. By definition, therefore, all prediction estimates can be incorrect. And really, the idea here is that the annual review sets factors that would construct, I guess, a cap on the rate level. We are more of a proponent of reasonability of range. So I think it's really important to look at this exercise as a way of having a range of reasonable factors to be used by the industry to set their own rates. If we go to the next slide.
Philippe, I'm just we're about 6 minutes left.
Perfect. I'll be quite quick.
Right.
So in conclusion, as I think we all know, there's a lot of uncertainty in the current environment as we are emerging from the pandemic. The macroeconomy is quite different than a few years ago regarding inflation, interest rate, and all that. FA has been and will always support step taking by the board to create a more flexible system and encourage the board to continue in that direction. As I said, rate making is always a prospective exercise, and again, looking at a range of reasonability approach remains our main recommendation instead of truly benchmarking. And I think we've said it before, and others have said it, a healthy private sector market is always the best environment to provide Albertans with competition and choice. And this is what we are trying to work towards. And on that, I will give the final comment to Saskia.
Thanks, Philippe. The last comment I would say is, I know we're talking about private passenger today, but fortunately, or probably unfortunately, private passenger vehicles don't drive on their own set of highways. They drive in the province along with commercial vehicles, truckers, And those two systems exist in not just parallel, but intertwined. And so this is not the subject today, but we would certainly welcome the opportunity to come and speak with the board separately on the issue. We know the ongoing challenge of commercial and interurban, the discussions around the grid. We've always appreciated the ongoing dialogue and the conversation that we've been able to keep with the board and the board with us. And so with that, I'll close it off today if there are any questions, but know that we see this as a step in a continued conversations between ourselves and the board. Thank you very much.
Thank you, Saskia, Philippe, and Derek. And just on the comment, we would always invite discussions with any stakeholders that fall outside the scope of this particular meeting. So you can always reach out to Lori, and we'd be happy to set that up. I now invite any of our board members to indicate if they have any questions or comments for the Facility Association. I think, Jay, you have a question or a comment?
Yeah, I actually have more of a comment than a question, but initially, thank you for your presentation. Always look forward to hearing from FA. So in the AIRB's opinion, the Facility Association remains an invaluable resource to Albertan auto insurance consumers. The AIRB has reviewed the FA's submission. We appreciate your prediction that the RSP market share will level off and stabilize in 2023 and 2024 after the peak in 2022. I think we also echo your comments in the presentation that the market should set their own rates using their own data. That we as a board, we look at a standard of reasonableness, but also we look to the industry to support their own assumptions and the data that they're providing us. We do look at all that. Oliver Wyman looks at that. It's a pretty broad consideration of all the factors when we look at a filing. We also look forward to future discussions with the FA on oversight of the RSP, and then we also look forward to probably more robust discussions regarding the future of the grid. So thank you.
Thank you.
Jamie, I think you're muted.
We had a meeting yesterday and I was muted about 80% of the time. So there's too many buttons on this screen. So we're going to move to item number 6, the Alberta Civil Trial Lawyers Association, where we have Owen Lewis, ACTLA Judicial District Representative for Grand Prairie, and Craig Allen, Independent Consulting Actuary. And I'll turn it over to you.
Thank you, Mr. Chair, and thank you, board members. Appreciate the opportunity to present again today. For those who have been around for a while, you'll note that I've presented for the last 5 years. I'm joined today by Craig Allen, our independent consulting actuary and Canadian fellow of the Canadian Institute of Actuaries and Casualty Actuarial Society. I'd like to begin, if we can move to the next slide, please. I'd like to begin with some of the general observations that we'll be making with respect to Oliver Wyman's report. With respect to the presentations that we've gone through in the last 5 years, we've demonstrated that there is inflation-adjusted balance and stabilization in not only bodily injury claims costs, but also all coverages. And most recently declined, that's obviously been noted. Driving patterns have changed, affecting accident frequency. This has been noted as well by Oliver Wyman in terms of the new normal. The insurance industry profits, there's been much discussion about that, and we'll present our information with respect to the profits experienced by the insurance industry with respect specifically to consumer motor vehicle in Alberta. The rate of return on investment, that was touched on in Oliver Wyman's report, and certainly something that we acknowledge and know that most, if not a large chunk of the money which is made by insurance companies is through their investments. and we'll talk a little bit on that. Direct compensation for property damage and the potential shift from what is an optional coverage to the mandatory coverage. Again, noted by Oliver Wyman, not really too certain what the reason for the shifting is. And then the annual increased benchmark provisions for general expenses, which continue to climb. So if we can move to the next slide, please. So with respect to all claims costs, and of course, we know this is a factor of severity as well as frequency. But what we have seen is a flattening since 2015, and then more recently, the significant decline in the claims costs for all coverages. So this is something which has been noted again by Oliver Wyman. In terms of cost pressures, this simply shows that we have a situation where the claims payouts and the claims costs aren't rising significantly. And in fact, with what we've seen with both COVID, but also Bill 41 in the last few years, we've had that significant reduction. So this is something that we noted years back, and I encourage people to go back and look at the submissions which have been made by the Alberta Civil Trial Lawyers Association in the past, which reinforces that the information that we provided 4 years ago indicating that this stabilization would occur has occurred. Now, nobody could predict COVID, so we're not going to go in and say that the more significant reductions that we've seen, we were able to demonstrate that. However, what we did show once COVID hit is that we expected that there was going to be a reduction in the claims costs, certainly with respect to bodily injury and property damage, given the lower frequency that was experienced as a result. We can move to the next slide. What this slide demonstrates is the specific loss per vehicle for bodily injury. And again, as noted by Oliver Wyman, there's that flattening which occurs, and then a period of steep decline beginning in 2020, 2021, and continuing on into 2022. Of note was the situation that at the meeting last year, it was indicated things are returning to pre-pandemic levels. So we're going to have a situation where all of these costs are suddenly going to increase significantly. That did not occur. And our projections last year were shown to be very, very conservative in terms of what it is that we expected would happen in 2022. But what we saw was that continued decline in the bodily injury claims costs. So the suggestion that it's a situation where bodily injury claims costs need to be held under control because of skyrocketing costs, that's simply not the case. It's not borne out by any of the information which Oliver Wyman has presented with respect to the last several years going back to 2015. And more significantly, in the new normal, which is anticipated, which we'll talk a little bit more about, we've seen a situation where bodily injury claims costs have actually declined on a per vehicle basis, a situation where frequency has declined significantly if one looks back from 2005. Several factors for that: safer vehicles, reforms with respect to Bill 41. But what we are seeing is a reduction in bodily injury claims costs, not an increase on a per vehicle basis. I also found it interesting that when looking at the forward-looking factors, it was a situation where the IBC's actuary, Mr. Miller, actually suggested a lower amount than Oliver Wyman with respect specifically to bodily injury. And I believe it was 4.2% as opposed to the 5% in terms of the future loss trend. But again, an acknowledgement that bodily injury costs are not a driver with respect to the claims costs generally. We can move to the next. And this flows into the fact that driving patterns have changed. The fact that we're doing this by video as opposed to my driving down to present in person is simply an example of that. We know that it hasn't returned to pre-pandemic levels. And quite frankly, I don't expect that it's going to be a situation where the downtown cores are going to see a return to 5 days a week, 8 hours a day. The cell phone data, which I found interesting in the downtown cores for both Edmonton and Calgary, at the start of this year was still down approximately 40%, 35 to 40% from pre-pandemic levels. So we do have this new normal, and this is something which has been acknowledged by Oliver Wyman as well. And we have that bodily injury, again, frequency and the cost, which has decreased significantly. Now, property damage has increased. Accident benefits, a small decrease of 6.6%, and collision has actually decreased 40%. We'll talk a little bit more about why we find it concerning in terms of property damage versus collision and the big discrepancy that we see between those two numbers, especially as it relates to frequency. But there seems to be a greater confidence now that a recovery to pre-pandemic levels in terms of the costs and the drivers, the frequency, isn't likely. That permanent changes in practices have led and will lead to a continuation of favorable frequency trends. As well, Bill 41 has also had an impact and effect in terms of bringing down the cost drivers. If we could move to the next slide. So Oliver Wyman's new frequency noted in the report or the new normal is based on frequency. Once you factor in Bill 41, which is expected to have an impact on severity, we estimate that there'll be a further decrease in terms of the bodily injury claims percentages. So the combined impact we calculate as a reduction of 33.5%. So again, those who may or may not be familiar with Bill 41, it's indicated in Oliver Wyman's report that a lot of Bill 41 isn't factored into the calculations because it's too early to assess what type of impact that's going to be. But it's a situation where, based on the projections, which was put forward by the IBC and by government in terms of what the change in the definition of minor injury would be, the changes to prejudgment interest, as well as the changes to the expert reports, which plaintiff's counsel are entitled to retain, that those costs would have dropped significantly as a result of Bill 41. So when we look at these types of projections, we look not only at the new normal, but also the impact of Bill 41. We can move to the next slide. Now, there's been much talk about the profits of the insurance companies. It's certainly a situation where I don't think anybody's going to dispute that over the course of the last 3 years, the insurance companies have experienced windfall profits. That wording was used in Oliver Wyman's reports previously, and it's certainly a situation where it's unprecedented, the levels of profit that the insurance companies have experienced over the course of the last 3 years. We acknowledge that COVID was a one-time type of event and one which is difficult when you're looking at the forward projections in terms of what it is that is going to happen in the upcoming year. And as noted in past reports, it was, we're going to have a swift return to pre-pandemic levels. Therefore, we need to set our rate setting on that basis. And of course, we know that didn't occur in 2021, and now we know it didn't occur in 2022. And we project that it's not going to occur in 2023 or beyond, as noted by Oliver Wyman, in part due to the new normal. Now, in terms of the profit percentage, which again, there's that goal of the 7% profit on premiums for the insurance companies to achieve, that's been exceeded significantly over the course of the last several years. And that, of course, would be money if there was that 7% that would be in the pockets of the consumers. That hasn't occurred. We know that that money has gone to the insurance companies and the shareholders. In terms of projecting forward, we project that that situation where that 7% is going to be exceeded, moving forward on the basis of the information which is presented in the report. We've also broken it down in terms of the pre-tax profits with respect to what is set out. I don't want to get into detail in terms of the differences between the Oliver Wyman profit provisions, the Craig Allen profit provisions, and then also the Giza provisions, which are included in the Oliver Wyman report. suffice to say, it's a situation where we are factoring in some of the implications of Bill 41, some of the higher reserve practices which have been noted through past years, as well as a calculation with respect to the property damage aspect in relation to the transition to direct compensation. And it's believed that there's a little bit of an actuarial type of recognizing this year as opposed to past years and just making a shift there. We could move to the next slide, please. So in terms of the realized profit provisions, again, looking at the 7%, these are the calculations as prepared. And in terms of the margins, we appreciate that the AIRB right now does not have any mechanism, that they simply look at the 7% profit provision and the information which is provided to set the rates moving forward. And with that uncertainty, we've certainly seen a situation where the insurance companies have experienced significant profits over and above the 7% profit provision. So we could move to the next, please.
Oh, and I'm just going to jump in. We're at 8-minute reminder.
Thank you. Appreciate that. So leading to the investment income, a situation where in 2022, and as mentioned, the stock market had a reduced rate of return. However, really that just takes into account a snapshot. We also know that the insurance companies who invest their funds invest them in laddered bonds that are paying at a certain percentage. And yes, in 2022, the bond market took a significant hit when you look at what it is that those underlying bonds would be worth if liquidated, but that's not how the insurance industry works. They simply have those rates of return. And of course, we all know that the rates of return for short-term investments in 2022 and now in 2023, you can have stable investments that are paying upwards of 4.5–5%, which are cashable within the next 90 days or cashable immediately for some of those. So when we look, and Mr. Allen has only used the 0.08% for 2022 in the calculations. If you factored in a more reasonable rate of return of 3%, those percentages in terms of profit margins would increase significantly. We can move to the next slide. So in terms of the overhead expenses, dealing with now with direct compensation for property damage. This, as noted by Oliver Wyman, we have a situation where somehow the frequency of collision is very low when compared to the property damage aspect for the mandatory coverage. So not too sure why the reason that we have this significant shift from collision to property damage, a decrease in the frequency. But what's interesting is that when you look at the premiums paid on collision, they haven't increased significantly over the last 4 or 5 years, but the profit provision has. So we just question why it is that we have this shift from what is optional coverage, the collision, to the mandatory coverage, which is now the new direct compensation model. We don't know what the reason for that is, but we just suggested that will take some additional review. If we could move to the next slide. The general expenses. This is something that we noted in our last report, a situation where the general expenses continue to increase on an annual basis. So notwithstanding that you had COVID, where a lot of people were shedding some of their costs in terms of the fixed costs and the variable costs, the percentage continues to rise on an annual basis. At the same point in time that the expense percentage rise, we also have an increase in premiums. So when we look at the money which is actually going then to the operating expenses, that has increased significantly, not only as a percentage, but when you actually look at the money which the insurance companies indicate are that portion which is recognized at now this year, the 27.6% for the general expenses. Now we know that the largest amount of that expense goes to brokers and acquisition costs, and certainly a situation where we've seen insurance companies buying up brokerages and consolidating that market. If we can move to the next slide. So in conclusion, it's a situation where the 7% profit target for insurance companies, I believe everybody's indicated that that is appropriate. It's a situation where we believe that that should include the return on capital. The direct compensation for property damage, that warrants further review, and a situation where is it a shifting from optional damage to mandatory coverage? We don't know, and I think Oliver Wyman has indicated that's an uncertainty as well. And finally, we believe that any forward-looking rate setting should take into account the new normal. It's a situation where it's been recognized now by Oliver Wyman, and quite frankly, I think it's been recognized by everybody who's in the industry, that there is this new normal, and that should be looked at when establishing the rates moving forward. So that, I believe, summarizes everything from our point. Certainly welcome any questions that you might have.
Oh, great. Thank you, Owen and Craig. I'll now invite any of our board members to indicate if they have any questions or comments for Owen or Craig. And I don't see any, but I do have a comment, and it would just on your concluding remarks, number 2. We are aware of the unexpected trends on the DCPD coverage. We're monitoring closely and reviewing the data, and we are working with our statistical service provider to ensure claims are properly reported to the correct coverage. So we are aware of those unexpected trends as well. So I just wanted to note that.
Appreciate that. Thank you. And appreciate the opportunity to present again, and welcome the opportunity to have further discussions, whether it be at board meetings or otherwise.
Great, super. Thank you very much. Okay, we're going to move on to agenda item number 7. So I invite Aviva Canada to share their views with us today. Aviva Canada is represented by Karen Otts, Senior VP Regulatory Government Relations, Fanny Paz-Prisant, Vice President of Street Pricing, and Marcos Young, Actuarial Managers. I'll turn it over to Aviva. And there's a lot of background noise I just heard, so I'm not sure. Oh, there we go. Okay, thank you. Okay, I'll turn it over to Aviva.
Thank you. Thanks very much, Mr. Chairman. Thank you very much for allowing us to present again. My job today is simply to introduce Fanny and Marco and to turn it over to them. So Fanny, let's kick it off and I'll turn it to you. Okay, maybe we can go to the next slide.
Karen, would you like me to take this? So it looks like you're still muted.
No, go ahead.
Oh,
go ahead.
Okay. Well, first, thank you very much. I'm sorry there's background noise. There's literally nobody else around me, so I don't know where it's coming from. So my apologies ahead of time. Thank you so much to the board and Lori for having us again here. We want to talk about generally we agree with Oliver Wyman's loss trend selections. They are appropriate at the aggregate level. We think there's still uncertainties about inflation, and we have some information about that on what we're seeing on our end. We do see the increase in physical damage collision severity that occurred in 2021. So we have, when we're calculating trends, we adjust those years for that additional inflation. For the industry, we acknowledge that the industry may be seeing something different with respect to Bill 41. However, for Aviva, we're not seeing the same impacts that were expected from Bill 41. We are seeing more claims in higher than I think the minor injury reform level is now at around 5,800. We're seeing more claims that are going over that amount, or the claims, even if they started as a minor injury, they're staying open for longer than 6 months, which kicks them to the higher level. Although we acknowledge that we see that the second half of 2022 had kind of like the start of a new normal, I don't think it's the end of that new normal, and we should just expect that that's the level and it's not going to go up or down from there. We think it's not reliable on its own. And of course, I'll have a slide on the auto theft that we're having here in Ontario, and I'll have a few words about that. And then, of course, we've all acknowledged that, and the AIRB is doing that we use our own data, and we expect to continue doing so. Next slide, please. Okay, so we've seen this before. We know that the Canadian CPI inflation did go up to a high end in the middle of 2022. It hit a high of 8%. The different economic trends that we follow, they're saying it's coming down. You can see the experience of May of 2023, it's around 4%. It has continued to come down, although it did tick up in July. But none of those economists are saying it's going to go down to the levels of 1 to 2% that we saw prior to the pandemic. We expect that the inflation will continue being in that 2 to 3%, which will continue to erode profit margins if we're not able to achieve sufficient rate. Also, the other thing that inflation does, of course, is it drives up wages, and it drives other components of the insurance product. Next slide, please. So, for example, this slide is about auto parts inflation. And what we have there is the auto parts inflation, which was like around 2% until about September of 2021. And then we see the sharp increase until September of 2022. And we expect that those will continue to be in that 5 to 6% instead of that 2 to 3%. So, we do take, when we do rate making, we do take into consideration the periods of lower inflation, but then when we do projections to the future, we will take a different approach for future trends, because this is what we're seeing. Next slide, please. Now, another component of our product, of course, is used car inflation. We know that it went to a high end in the, up to about September of 2022, where used car prices were, 20 to 25% higher than they had been in prior years, because, dealerships basically had a problem getting stock for their rooms, and they couldn't sell vehicles. You just had to go to any car dealership and see they had maybe 1 or 2 models, and they would say, no, these are not for sale. And you had to put yourself on a list and sometimes pay a premium for getting a new car, which of course that drove the used car price up. So it's come down, but again, it's not coming down to that 0 to 2% that we had seen before the pandemic. It's more around that 3 to 5%. And of course, this has a direct impact on physical damage claims. Next slide, please. I think this is my next to last graph. The Canadian wages. So we do have a high increase in around 2019, 2020. We think it was due to the all the government programs to help people who were affected by the pandemic. And then it's come down since then, but again, it went down and is back up at a higher level than it was before. So now that the Canadian wages are going up somewhere between the 4 to 6%, whereas before we were seeing increases on 2 to 3%. This has a direct impact on the wages that we pay to repair shops, on wages that we pay to our own staff, but also it has an impact on bodily injury claims, and it has an impact on accident benefit claims, because anything related to medical, those wages will also be going up. Next slide, please. So we talked a lot about inflation, and and I'm showing you a few graphs about, what are we seeing, how much higher it is. So when we're calculating trends, we're using data from prior to 2019. That's kind of like before the pandemic. Then we have a couple of years pandemic related that we need to adjust. And if we just use that data for calculating a trend going forward, it will tend to underestimate the overall inflation or the overall trends that we are really seeing in practice. So what we've done is we calculate a baseline inflation factor, which you see there on the right, of auto physical damage about 1.7, auto accident benefits 1.8, and so forth. And then we use the CPI information split by type of claim and the components of the claim. We assign the right weights, and that's how we have come up with inflation shock by coverage on a year-over-year basis. So the 2022, we saw those graphs. They were all much higher. 11.5% is what we assign. It's the inflation on top of what we would see on the regular data. And then we're still projecting forward that there will be a small component of inflation shock going forward of 2.5%, and then tapering down over time. For bodily injury and for accident benefits, it's more of an expert opinion. We work very closely with our claims team. They have an analytics team and a claims team. These are the inflation adjustments that we would do are based on those conversations and the expert opinion from our claims analytics team. So main point I want you to take from this is that we expect the inflation shock to go beyond 2021, and that we need to factor these components when we're calculating trends. Next slide, please. So I mentioned before that for Aviva, we're not seeing the impact on BI as the industry are seeing our BI costs continue to increase. These are the historical severities that were in the Oliver Wyman report. And you can see on the left, it came down during it was increasing. There was the Bill 41, then there was the pandemic around the same time. So as Oliver Wyman says on their report, those results cannot be separated. And we see an increase on the second half of 2022. Then the healthcare index is an interesting one, because you see kind of bumping along over time, and kind of with what I would say prior to 2022 first half, in an overall kind of decreasing level. But you definitely see that increase on the last few points for healthcare costs. So we think that that the healthcare costs will start increasing more than what we have predicted before. We're not seeing it yet on the severities, but based on the healthcare index here, it looks like it's beginning to increase on those last few points on the right-hand side, on the very end of the graph on the right-hand side. Next slide, please. Marco?
Fanny, I'm just going to jump in.
Yeah.
8 minutes remaining.
Okay.
Thank you so
Thank
much.
you both. Fanny talked about the uncertainties for severity, but there are actually uncertainties for frequency as well. During COVID, the frequency level has gone down because people stayed at home and they drove less. So before projecting the frequency level for the future, we would retrospectively adjust the COVID years to the pre-pandemic. However, if you think there is a new normal, which has a completely different frequency level than what we had before the pandemic, then we should also prospectively adjust the historical frequency level. Well, in Oliver Wyman's reports, 2022 second half is suggested to be the starting points of new normal. And the historical frequency is also recommended to be adjusted prospectively to the 2022 second half frequency level after trending. However, Aviva think it's too early to conclude 2022 second half as the new normal, because the frequency level is still subject to change by more than just the regular trend. For example, companies continue to encourage employees to spend more days working in the office, which will lead to more driving on the road and eventually more accidents, unfortunately. And if we look at Ontario for reference, their frequency level is continuing to trend upward to go back to the pre-pandemic level. Data in general suggests people are driving more distance and driving more. Statistic-wise, 2022 second half is just one data point, so it lacks the credibility. If we look at the Alberta property damage industry claim frequency level, specifically, it has increased significantly from the first half of 2022 to the second half of 2022. It has increased by more than 40% in just half a year. There's no good justification to it for me. Some may suggest it's due to claims being shifted from collision to PD or DC, but in theory, it shouldn't, because collision claims are at-fault claims. So the increase can just be fluctuation, and fluctuations can happen to all other kinds of claims. So in my opinion, 2022 second half can be used as a reference, but we cannot blindly accept that as the new normal, because COVID, the disease itself, has died down. Companies should gather additional data and insights regarding mobility and social culture and incorporate actuarial judgment in their projection. Now, I'll pass it back to Fanny to talk about the auto theft crisis happening in Ontario.
Thank you, Marco. Okay, so I promised that I would talk a little bit about Ontario theft and what's going on here. So the gray lines that you see there, it's kind of trying to frame the COVID periods. It's not perfect, but it's just to give you a frame of reference. And then we have the blue line, which is the severity, and the green line, which is the frequency. And this is like a relative to 2018. So what we see is a relative to 2018, all the way to about the end to the beginning of the COVID pandemic. You know, it was kind of hovering around 1.1, 1.2. Both of them, frequencies and severities, were not changing much. Then we move into the pandemic, and it starts going up. Severity, the blue line, increasing now all the way up to 2023. Second quarter, we see it increases, is now almost 2.5 times higher than it was relative to 2018. But the big number there, the big line that I would like you to look at is actually the frequency number, because the frequency is now over 3.5 times higher than it was in 2018. To put it into context, our frequency of theft used to be maybe 10% of a total comprehensive frequency, is now over double of what it was in a year or two ago. That's how much, why is there a problem with theft in Ontario? So Viva is taking the problem on with, kind of like holding on by the horns to make sure that we provide our customers who have vehicles that are more likely to be stolen. We're providing free installation of theft recovery devices. And then we're also advising customers. But in general, Ontario is taking this as a problem. So it's not just insurance companies or Viva in particular doing something. The media is all over it. The government is all over it. The local governments are all over it, because they steal these organized crime gangs. These are not kids stealing cars for the fun of it. These theft gangs are taking vehicles, they put them on a truck. Within 24 hours, they're on a container out of a port on their way to Europe or to Africa. It is that fast. So having the recovery device in the vehicles, we've been able to find our own vehicles. In one of the containers, we actually found the vehicle that belonged to another insurance company, but that's the way we are tackling this issue. We think that the organized crime that used to have a heavy theft problem in Quebec moved to Ontario, and we think they're going to start moving west. Now, if I were a thief, I would probably move to British Columbia because there's a port right there, but I wouldn't be surprised if they stop on their way in Alberta, and they'll probably start tracking vehicles, high frequency vehicles, high frequency theft vehicles, and start tracking them to British Columbia to put them in a ship container. It is a big problem. It's costing millions and millions of dollars. And so it's important for for the regulator and the government to also take this into consideration and not wait until it becomes a problem, but do something ahead of time.
Okay, we're almost out of time. I want to make sure I allow some time for questions and comments.
Sure. One last slide, which I think is just an overview of what we talked about. Elevated inflation, we talked about that. We're still having uncertainties from Bill 41. There's still uncertainties what the new normal frequency level will really be. And of course, that potential migration of auto theft from Ontario to Alberta. We really appreciate the time and thank the board for allowing us to do this presentation.
Great, thank you, Karen, Fanny, and Marco. I'm going to now invite any board member to indicate if there's any questions or comments. And I think we have Chris.
Hi, thanks very much, Mr. Chair. And thanks for the presentation, very informative. Just a couple of points that I wanted to ask you about. You mentioned the migration of auto theft out of Ontario and potentially to the West and Alberta in particular. And we know you've taken some steps in Ontario to try and reduce thefts among your policyholders. Do you plan to proactively offer those types of steps, including the tracking tool that you mentioned in Alberta, before it becomes a problem here?
Yeah. So we're looking. The company that we use in Ontario does not. It's an all-inclusive type of company. They put the devices around the vehicle, and then they monitor it on a regular basis over 3 years. They also have, once if a person calls and says, hey, my car has been stolen, they immediately track it. And then they have vehicles, they inform the police, and they have vehicles that go and find the vehicle. That's how we've been able to recover them. That company does not doing business in Alberta yet. So we're looking at a different provider that offers a similar type of service. But the intention would be to encourage our insureds to also install these devices.
Great, thank you very much. We look forward to hearing more about that as time goes on. Using technology to keep policies down for.
Unfortunately, it doesn't prevent the theft. I mean,
Right.
they put a little bit of they do a little thing on the window that says, hey, this vehicle has a tracking device, but it doesn't prevent the theft. It's a recovery mechanism.
Thank you, Fanny. You also spoke a fair bit about inflation. And of course, we've all felt that in this industry and in our own households and pocketbooks. And you mentioned that you think as we exit 2024, we'll start to see some reduction of inflation shock. Will that be passed on to Alberta drivers in the way of a rate reduction once we get to that point?
So the way it would be done is that we would put it into the trends and assume that it's coming down over time. It's not, because remember, it's a reduction on the frequency that we have seen so far. So it's not going to be that it goes down and therefore the trend goes down. Instead of taking a trend from prior history and then adjusting it additionally for that additional inflation, that adjustment is going to be smaller. And of course, it will be represented in our trend selections when we send filings to the board.
Thank you very much. We look forward to watching that progress. And I hope you're right about inflation coming down over the next few years.
Yeah.
Thanks.
Thank you.
All right, great. Thanks again, Aviva. We appreciate the information you provided. So that now concludes today's presentations. On behalf of the AIRB board members and staff, I would like to extend our thanks to everyone in attendance. We appreciate those who took time to provide written submissions and make presentations today. Input from stakeholders is an important component of the annual review process. All feedback and comments are welcomed and appreciated. The AIRB will consider the information received from today's presentations and the written submissions as it deliberates in setting industry benchmarks, which will be used in our review of insurer rate filings effective October 1st, 2023. The benchmarks are used in review of rate filings, and insurer-specific data is compared to the industry benchmarks for reasonableness. Insurers are expected to use their data where credible. Where an insurer's results differ significantly from industry results, we will seek additional information and support to understand those variances. We will consult with our actuary, Oliver Wyman, to determine any additional information is required to finalize our 2023 annual review report, which the AIRB must post to our website no later than September 30th, 2023. As a reminder, following today's meeting, the stakeholder presentations will be posted on our website at airb.alberta.ca. A recording of today's meeting will also be available on our website no later than August 31st, 2023. Again, I would like to thank today's presenters for assisting us in gathering information and data to support our decisions for the industry benchmarks. I would also like to thank Encore for their work behind the scenes, assisting with today's presentations, and very few minor glitches, so well done. And having said that, the meeting is adjourned. Have a great day, and thanks again.